Hello everyone and welcome back for our next session, a deep dive into asset management and its resiliency. Please don't forget to use the Swap Card app to submit your questions and answer the poll should the EU set stricter limits on delegation for managers outside the bloc. We will look at results at the end of our session and you can tweet us using the hashtag PoliticoFS. Let me introduce my fantastic panel. First up, I have Natasha Cazenave, Managing Director for Policy and International Affairs at the Autorité des Marchés Financiers in France. I have Francesco Mazzavero, Head of the European Systemic Risk Board. Caroline Nachtegaal, a Dutch member of the European Parliament for the Renew Group. And Eric Pan, Chief Executive Officer of ICI Global. So thank you very much all for joining. During this panel, we'll talk about how asset managers fared during the crisis or the turmoil back in March. We'll look at what reforms might be necessary, and we'll also touch on delegation, the outsourcing model for the fund industry. So to get started, if we could kind of cast our minds back to about this time last year when the pandemic first started to spread. The European Systemic Risk Board had warned previously about funds kind of acting as a tinderbox in a crisis and potentially spreading risks around the financial system. So Francesco, if I could kind of start with you, were those fears confirmed? What did you see back in March?
Well, thank you very much for having me here. And if I may speak one second, not about March, but about now, what is important is to think that some of the vulnerabilities are still there. So there is a very important exposure of investment funds to corporate bonds. There has been a very strong increase in duration position of investment funds. So it's not that we are back to normal. But basically what happened in March was as a consequence, of course, of the shock. There was a clear search for liquidity. This has been hitting in particular in high yield and investment grade corporate bond funds, certain types of money market funds and exchange traded funds. This also identified liquidity mismatches in certain types of open-ended investment funds. And of course, this has been amplifying market volatility. Basically what we have also seen is that some open-ended investment funds had to sell securities at prices below market value. We saw also a very large increase in daily variation margin calls. So thinking only of what we have seen from EMIR data on variation margins for Euro area funds, we have seen that margin calls have been increasing fivefold from around 2 billion in the first half of February to over 10 billion in the second half of March. And of course, what we have also seen is that funds had to use liquidity management tools, which was by itself right, to help address outflows and valuation and uncertainties. This happened in different ways. But let's be also very clear. So without an intervention of central banks on both sides of the Atlantic in different ways, which calmed have been the situation, we don't know whether there would have been more than this. Thank you.
Natasha, does that tally with what you saw in France? It took a kind of central bank intervention to kind of calm the markets.
So thank you for the invitation and thank you for your question. I think yes, we agree that there was quite a significant market stress that investment funds had to weather through. I think that we would make a difference between different types of funds in our experience, what we've seen in France and what we've seen internationally and in the EU what we see is that actually we had the opportunity to go through a real life stress test of a number of assumptions that we had been working on at the international level. We had been advocating with others, and of course the ESRB and other institutions, for strengthening the liquidity risk management framework. So what we've seen generally is that, without being too complacent, overall the investment fund industry managed to deal with this extreme market conditions and to meet redemptions in general, with very rare cases, as was mentioned by Francesco, of situations where funds had to actually go all the way to suspend redemptions. That was particularly true for a small number of funds, but it's important to highlight open-ended real estate funds, some bond funds, and a number of employee savings schemes, in most cases for valuation uncertainties, but in other cases because of redemption pressures. Where we do see a very significant difference, and where we think that the investment fund industry went through acute stress that was only alleviated by massive and very voluntary central bank interventions, was the money market fund space. In France, to give you an example, what we saw is the magnitude of redemptions was comparable to what we experienced in the global financial crisis. So approximately 13% of assets under management, but in a much shorter amount of time, in only 2 weeks. So that was a massive amount of redemptions to deal with. At the same time, the secondary markets were frozen, and so it was very difficult for managers to find the liquidity to meet those redemptions. We saw that banks were either unwilling or unable to provide liquidity on the short-term debt securities, and some non-financial corporates could not issue debt at that moment. So only central bank interventions could actually contribute to alleviating that stress. That being said, I think it's important to say that the framework was strengthened after the global financial crisis. So money market funds entered this stress with strengthened framework, with more resilience. But it's true that we have to draw lessons from the fact that it's the second time that they were hit. And so we have to see how we can improve. There are two lessons from our perspective in the money market fund space we need to be cautious about. The first is that the previous crisis showed us that they were exposed to credit risks, and we put in place safeguards for that. We need to increment and make sure that they are now capable to weather a liquidity crisis. And the second element that we would like to stress is that this also showed the importance of interconnections, and the fact that money market funds are actually highly interconnected with other parts of the financial system, and we need to be mindful of how that interacts and how we respond to that. Just to close, one very quick remark to mention that what we've seen since is that gradually the amounts of assets under management have actually very significantly increased, and we are now in France at levels that are way above the pre-crisis levels, for example, in money market funds.
Okay, thank you very much. Eric, you're sitting in the US. Could you kind of give us, do you agree with that assessment? And could you give us a bit of a comparison with what happened in the US?
So I actually do agree a lot with what Natasha said. I think she made a number of very important points. The fact that investment funds in general were able to meet redemptions, even under a period of great stress. I think the fact that Natasha described the March 2020 period as a real life stress test is absolutely correct. When we do look at money market funds, the fact that the short-term funding markets were frozen was definitely a reason why there was pressures on money market funds. But I think one of the important takeaways is there were reforms that were put in place back in 2014 here in the United States that actually did make those funds more resilient and more able to bear the pressures they were under. Now, of course, central bank support by the Fed in the United States, but also the ECB in Europe, was incredibly important. And I think what we see is the central banks carried out what is a traditional central bank function. And today, or actually even shortly after March 2020, you saw a return to a degree of normalcy, that the markets recovered, and if anything, the markets actually become more robust. So I think what's really important is to understand, as we consider reforms on investment funds, were the funds the cause of the liquidity crisis, or were they a victim of the liquidity crisis? And here I think that there's actually a very important debate that needs to happen. I think people, including Fed Governor Lael Brainard, have noted what happened with US Treasury markets. That, of course, happened in early March, even before pressure started being made on funds here in the United States. And then we have to look at the question of, well, why were the markets frozen? Key players did not participate in the market. I think that international groups like IOSCO have noted this issue and have looked at questions of, well, the role of dealers in the market, the pressures that were put on them and other key market players. And I think that's actually where we need to do a lot of examination.
Just to come back to one point Francesca made at the beginning, that we're maybe not, we're still seeing some of these vulnerabilities. You mentioned normalcy. Do you disagree with that then? You think we're kind of back to where we were beforehand? Is
that a question to me?
Yes, sorry.
No. I think here I agree with actually both of the previous speakers in that I think whenever you have a stress test like we went through in March, it is good practice for regulators and policymakers to look seriously at how existing rules and regulations work and to consider should there be improvements. These real-life stress tests show you how market participants actually perform in real-life conditions. But when I say that we've returned back to sort of a robust market, the fact that assets under management have gone back up, money market funds today are operating, I think, at the same degree that they were operating before March 2020, shows that the markets have recovered. So does that mean that we should not look seriously at what happened in March? Of course we should. And I think the discussions in the Financial Stability Board, as well as what's happening here in the United States, are absolutely spot on. But I think we also have to recognize the fact that the markets are also working quite well today.
Okay, thank you. Caroline, if I could bring you in, I think you have some expertise on clearinghouses, and Francesca mentioned at the beginning the issue with margin calls. So I wondered if you think that was one of the big problems in this instance.
Yes, thank you so much. And well, I think what previous speaker said was quite relevant. And indeed, when you look to in March when the pandemic broke out in Europe, I think what you saw is that systematic stress very rapidly increased the levels close to those seen during the global financial crisis of 10 years ago. That was what Natasha also mentioned. So key parts of the financial system more or less froze. So the fact that liquidity dried up and price discovery was impaired, but I think it's correct to say what could we do? And yes, you referred to my work on the CCPs, and yes, what I saw last year that when I worked on the central counterparties, the fact is that what you would like to do is to design the framework to enable CCPs in the difficulty to continue clearing services while minimizing the risk that taxpayers might have bail them out. And I think it's very important to have, in these times of crisis, these tools to handle. And in that case, what Francesca said at the beginning about that there still were some vulnerabilities, I think that's correct. And I'm very happy to see right now also in the European Parliament that we should stimulate the fact how we could develop also the capital market union, because we see nowadays more and more that our economy should become less independent on bank financing only. So I think it's crucial these days that we could also, from our part in the European Parliament, to focus also on the development of the CMU.
So if we kind of take the points that you've made into account, but looking maybe more specifically at what reforms might be useful as a result, Francesco, if I could kind of get you to weigh in again, are there, a couple of the panelists mentioned money market funds, but are there fixes there that you would like to see or in other areas of the market?
Well, first of all, money market funds, it's important to say, as has been already mentioned, there is a stream of work at international level. As you know, there will be a consultative paper which will most probably presented to industry in June, July. And then there will be a document of the FSB in around September, October. We ourselves as the SRB will most probably bring our position, which will be addressed probably to the European Commission by the end of the year. Now, without going now into technicalities, also because we have to take account of the international level, I think that there are three important points which I think are part of our diagnosis and of our policy 9. The first one is that we have to address the issue of the first mover incentives. This is something, by the way, which we already referred to in a previous recommendation in 2012. The second thing is that we should address all the issues comprehensively of money market funds, not only the low volatility ones, which have been those most hit in March. And the third is that the industry must find a business model which is sustainable without the need of intervention of central banks. There's only one point in which I would say cautiously disagree with what I've heard. I don't think it is the role of central banks to stabilize investment funds industry. Thank you.
It's interesting you mentioned the kind of first mover incentive. Is that a problem, do you think, that needs a fix, Natasha?
I think there are, if we can talk about the reforms, I think maybe taking a little step back from where we have started. In the EU, in 2021 is going to be a very exciting year. We have quite a number of reforms that will be discussed and that we can think about. If we start with money market funds, yes, it's true, as Francesco very rightly pointed out, and Eric as well, there are important discussions taking place at the international level. The EU is very heavily involved in those discussions and will have to reflect on those analyses to see how, if and how to adjust the European framework, of course. So there are also at this time, there are discussions about weighing different options or what would be appropriate, and we'll need to tailor that to the European system to see what is the most appropriate. Maybe just to share some of the AMF's perspective, we have a significant money market fund here in France, and we've been working extensively with our colleagues on this. We have a number of points that we think need to be introduced. We would think, for example, that we need to reinforce the liquidity buffers, or for example, considering perhaps having some counter-cyclical buffers, and we hope that that will be discussed in detail coming forward. We also think that we need to think about mechanisms to refrain some of the redemption pressure. And so there's been conversations about, for example, swing pricing or similar mechanisms. We also think that that would be an improvement through the existing system. And then in the EU, we have a specific issue around the way sponsor support is framed that we can probably discuss. But as Francesco said, we'll need to be consistent with the international level. We also need to look at some of the recommendations that European institutions have already expressed, like the ESRB in the first place. But as I mentioned, maybe if I can keep the floor 5 minutes, I just wanted to maybe take the opportunity to think about broader reforms that we can think about in the EU this year, because we have significant pieces of legislation coming for review, as I mentioned, like the Alternative Investment Fund Managers Directive. It's the first time we're going to review this text. It's a very structural piece in the European framework that was designed right after the global financial crisis. I think it's relevant also in this conversation. And we'd like to put forward a number of areas. First, to say that we think it works well. I think it's a consensus to say that that framework actually has delivered on the policy intentions. But there are some targeted areas where we can improve it. The first of which being liquidity risk management, precisely where we think the European framework can be strengthened to make sure that all countries provide for liquidity management tools, so swing pricing, gates, redemptions, and notice periods, that all those are available to managers. We also think that there can be further guidance from ESMA and also possibly notifications to authorities. We'll talk about delegation later, but it's also an area where we think that the framework can be strengthened. A number of other areas that I will just mention is improving the reporting requirements. We would also like to see some cross-border supervision clarifications when we have cross-border activities. We think we can improve the system there. And maybe looking forward a little bit away from the resilience of our system, 2021 will also be a year where we'll have to think about rethinking, reshaping the European long-term investment fund regulation that has not met the policy objective, and it's a frustration that it hasn't delivered on what the co-legislator had hoped for. So we need to think about how we can improve it. And here also there will be a review on the table later this year. I think it's interesting that we can also mention that as an important area in this recovery phase. It can be part of the solution to contribute to channel the funds towards more long-term investments and SMEs. As Caroline was mentioning, we need to consider that reducing the dependence on bank funding, and it's a one part of the CMU project here in the EU. And the last element I wanted to mention, if we think about our framework, is of course, how can the asset management industry contribute to the Green Deal and to the transition to a more sustainable economy? And here too, the asset management industry has a role to play as it embraces this trend and has been making very strong commitments. We think it's important that we gradually come to a more European approach to prevent greenwashing and reduce fragmentation. There are important pieces of legislation coming up in the EU, and we'll need to consider collectively how we can come to a European approach to have perhaps a European label or greenwashing rules together.
Can I just ask you on one of the points that you mentioned, the improvement of cross-border supervision? Could you just explain a little bit more what you're kind of thinking there?
Yeah, so one of the great successes in the EU is the fact that in the asset management industry is the best example of how the internal market can function. We very often have a manager in a country, you'll have the funds that will be domiciled in another country, and they will be marketed in multiple countries all over the EU. And that is one of the great successes. But that raises supervisory challenges in how that's implemented. And what we found looking in detail is that sometimes in our supervisory experience, either rules are not so clear or there's a latency because we need to coordinate with other authorities. So we're making some proposals in the areas where you have a management passport that perhaps we could improve the rules and make them clearer on who is responsible of what to strengthen further our internal market.
Okay, thank you. That's very clear. Caroline, Natasha just ran through quite an extensive reform program that's coming up. What would you kind of like to see prioritized, or where do you think the kind of political appetite is for change in Brussels?
Yes, well, I think what the reforms Natasha mentioned, most of them I can underline. The fact is the amount of reforms and the work we have to do. But I personally think that you touch upon some other things. What you now see, especially during this pandemic, that the market is already bounced back, sky high after a sharp decline when we saw that Corona first appeared. But the long-term effect, and I think that's important, that's what you mentioned as well with her reform package. I think that the long-term effects remain to be seen. So that the pandemic might have accelerated trends that were already visible in the industry, rather than that it will be a sort of a fundamental game changer. I think that's one point we could mention. So in that case, it's relevant to look at which type of reforms. And one of the points you mentioned about the liquidity buffers, I fully agree with. I think it's so important to look at these types of buffers, but you also focus on more the sustainable side and the Green Deal part. And yet I think that, again, this shows that if we would like to grow, that it should be also and can be hand in hand with the sustainable investment. So, for instance, we were in the European Parliament already busy. It was on the agenda how to work on that, and also most of the asset managers, let's just say, were emerged in the pandemic in that way. What I saw from my more political perspective triggered a sort of a boost in the ambition of companies to integrate, for example, the ESG criteria into their investment process. Also as a demand from the customers also increased. And I think that's relevant to look at the market. And the thing a lot of politicians most of the time are doing is sort of thinking that we could think and take action on behalf of the sector. But I think what we should do is listen to the sector, is listen to the financial market, to the asset managers, because they can give us the inside views. What are the long-term trends? What should we do? What will be the best reform package? Maybe in the short term, but more important in my opinion for the long term.
Eric, what do you think should be on the reform agenda? Do you agree the counter-cyclical buffers for money market funds?
So I think there are a few things I would say. So first, I think the previous two comments, one takeaway is asset management is actually really important to global financial systems. You know, we have a lot of expectations for what investment funds can do, and that includes money market funds. So, you know, when I hear comments like, well, business models need to change, you know, yes, to the extent that you want funds to be able to continue to perform the service that they're providing right now to the financial system. That's something that regulators need to keep in mind. I think second is, as we consider reforms, especially in light of what happened last March, we also have to be honest about what actually happened in March, which is there was a tremendous public health crisis. You know, the idea that in a span of a few days, the economies of North America, Europe, and most of the major financial centers in Asia all shut down in a very short period of time is really unprecedented. And all of the talk about this notion of the dash for cash is all in the context of tremendous economic uncertainty at the time. Companies pulling on credit lines in order to make sure to have enough cash on hand. Households doing the same thing, all because if we look back a year ago, people actually didn't know what was going to happen in the short term. And in such a condition, clearly there was extreme stress on the markets, and I would say unprecedented stress on the markets. And a lot of those stresses where you did not have supply meeting demand resulted in having a domino effect on different areas, including funds. So I think we have to look at really what happened. And I think that leads to the other observation, looking at everything together. A lot of talk in the regulatory community about doing a holistic review. And that is actually something which we're very supportive of, because I think you have to look at the performance of all different parts of the financial system, because they do affect each other. The financial system does not work in silos. And so as we consider reforms, we need to also balance what we do in one area, whether it be money market funds, whether it be open-end funds, but also look how this impacts the interactions with other areas of the market, including the role of banks and other key financial participants. And my last comment has to do with specifically money market funds, because, you know, Hannah, you asked the original question, okay, in the case of money market funds, what should be appropriate? I think one thing is this notion of first mover advantage. The linkage between kind of redemption fees or gates with some hard limit on liquidity, in the United States, that being 30%, clearly creates a condition where people seeing a fund reaching 30% start getting worried that they're going to face a penalty. And I think that's a legitimate issue of looking at investor behavior, looking at how they respond to hard rules, cliff effects, and we should be looking to alternatives.
Francesco, do you want to weigh in on that? Maybe partly what Eric just said about the kind of crisis weighing on funds, maybe rather than the other way around, and that issue with buffers. You know, the ESRB has called for some kind of macroprudential framework for funds, but is there this kind of incentive problem where once you start getting close to that threshold, as we saw in some of the money market funds, it actually works as a kind of disincentive?
Well, honestly, I would not like to now to go in the story of buffers. Otherwise, the people will immediately tell that we're using, so to speak, bank-like type of instruments for. So I'm more thinking, if I may, at a certain time to broaden the story, if I may. So of course, March has been something which has been determined very much by the crisis and the COVID, but of course it is also the consequence of a situation of structurally low interest rates and yield curve, and underlying situation of weakness in which possibly very large segments of the financial sector are because of this. And the reality is that this is such a structural and prolonged change in the way in which financial markets are confronted that we do not know yet how to, so to speak, to accommodate it. And this is an issue to which not only investment funds or money market funds are exposed, but there is the problem of insurance, is the problem of pension funds. Some of these have been, by the way, hit by the same very large margin calls to which investment funds have been confronted. Banks. And I think we need to have, I agree on the fact that we need to have a comprehensive view of what is happening in the financial sector, but probably we have to go it really doing very thoroughly, looking at some fundamentals. So not in order to avoid reform in one sector, but in order to understand that here there are fundamental issues, fundamental imbalances, which cannot be very easily addressed. And once again, it's important to understand that all of this cannot finish in the way that central banks are recurrently going to get the financial sector out of these difficulties. So we are asking central banks to do too many things, and at a certain time it might be difficult for them to deliver.
So you're referring now to the search for yield. Is that what you're referring to, the kind of pressure?
Well, of course. I mean, this is obviously, I started by saying that we still see an issue of widespread exposure of investment funds to illiquid assets, an increase in the duration of their portfolio. By the way, if it were true, something which I personally do not believe, that there is a fundamental movement of interest rates in the sense of so to speak, of an increase of the yield curve. This will be a problem. This will be a problem.
Natasha, we've touched there just on some of the liquidity issues in funds and investments in real estate, perhaps. What can be done to kind of address those liquidity mismatches in a broader range of open-ended funds? And I also wanted to ask, the AMF intervened to some extent in the case of H2O during the summer. Did you feel like you had an extensive regulatory toolbox even to help in that case, or could you have done with more powers there?
Okay, so let me start with the broad question of liquidity risk management. We've been advocating for stronger requirements, like, as I said earlier, for a long time. It's very important that all managers are equipped with the appropriate tools that they can then tailor to the situation they're facing. There are broad range of tools that exist, but what we see is in the EU, we still don't have in all countries all the tools available, or in some cases they are there, but they are practicalities that need to be addressed so that they can actually be implemented. So we really feel that is an area that needs to be strengthened. And also, we have a very strong framework under one directive, the Alternative Investment Fund Directive, and we don't have a similar robust framework in UCITS. We should apply the same rules across the board and strengthen it. And as I said, we also think we can probably provide some European guidance to make sure we have a consistent understanding of how we're supposed to use those tools across the European jurisdictions. So there are still elements that can be strengthened, even if the framework, as I said, again, is already very robust. One element that is key in this area is the consistency between assets and liabilities. And that's the reason why, for example, when we advocate for reforms of the European long-term investment fund regulation, we're supportive of having a product that remains closed-ended, that is clearly sold where with appropriate advice if we want to have retail investors invested, but it has to remain closed-ended so you don't create that mismatch between precisely the liquidity of the assets and the redemption terms that you're offering to your investors. At the same time, it's a challenge because we're often told that investors want liquidity, and then we are suggesting, for example, for consideration by the European co-legislators of thinking about a secondary market liquidity or other mechanisms to be able to provide, in some cases, liquidity to investors who need it, while preserving the robustness of the product itself and not creating that mismatch. But yes, we need to look at that. Maybe I should also add that ESMA has been conducting a very significant exercise, a common supervisory action on liquidity risk management and the usage framework, quite extensive. It will be publishing on that soon. We'll see how supervisors have looked into, in practice, how managers manage liquidity. On H2O, we never comment on individual cases, so I'm not habilitated to say anything. The only thing I would comment on is the fact that the European framework gives the tools to European supervisors to act when they deem that it's warranted. So the European legislation does give us the power, if we think it's necessary, to go in and require suspension of redemptions if we think it's in the best interest of the general public or investors. I think that's the important takeaway. It's very rare that it's been activated, and yes, we have done so lately.
Could there be more clarity on when you can make those kind of interventions? Would that be helpful?
I'm not convinced. I think it's very important that it's tailored to the situation. It's an extreme tool for a supervisor who is not in the first row and managing the fund day to day to take that kind of measure. It seems to me that the way it's crafted today, at least in our experience, it functioned. It needs to be done when it's deemed to be in the best interest of the general public.
Okay. I'd just like to remind the audience, we've got just under 10 minutes left. If they want to pose any questions, please do. Just before we move on to delegation, Eric, if I could just ask you about the liquidity issue. Should there be a better match between close-ended funds and hard-to-sell assets? Could the industry, improve there, or what do you think?
So I think this is a legitimate question that to be studied. And I say that not to give you a non-answer as much as personally I don't know the answer. I haven't looked into this issue, but I also have, like ICI, for example, has done analysis that shows that assumptions that somehow investor behavior has changed, like that somehow that the behavior of how investors react to certain events, which has been asserted by some researchers as justification for new regulation. It hasn't been supported actually by historical evidence. And so when I point that out only because I think that, in order to come up with a good solution to an issue, you first have to understand, okay, so what's the problem you're trying to solve? And so I don't believe in regulation for regulation's sake. I as representing regulated funds and also as someone who used to be involved in regulation, I think the goal everyone could agree to is smart regulation, right? So we want regulation that makes sense, and that puts it it's incumbent on regulators to really first justify why they think something needs to be done. And that's a discussion where I think we're still at, and one that we would welcome the opportunity to be participants in that discussion.
Caroline, it's early days in terms of the review of AFMD in the European Parliament, but do you think, you mentioned the Capital Markets Union, do you think that there could be also a more positive role here in terms of getting retail investors involved in capital markets? Funds can be an important vehicle there.
Yes. Well, first of all, let me react on what Eric said, because I think it's a very relevant point you mentioned regarding the hard-to-sell assets. And well, maybe when you look for the point of view from an investor, it might be, well, let's say quite logic to invest more in illiquid products. But from more my side, or let's say a policy point of view, it's also desirable to have investors there are willing to make the long-term investments, which can, of course, be less liquid in a way. And that was also, sort of state what Francesca was referring to, also about the role and the consistent role European Union or European Parliament should play regarding the framework. It should be consistent because European regulatory framework also, let's say, distinguish between more liquid assets or, let's say, more assets for long term. And in that way, within ESMA stress testing, liquidity risk, we have the opportunity that we see it's an important component nowadays. So what I do hope is that hopefully the shock we have seen regarding COVID, that it can also be used to further enhance the way of stress testing. And regarding your question of the CMU, maybe I hope that the CMU can get a boost as well. The financial sector landscape in the whole zone of our euro area has changed, well, let's say quite a bit in the last, at least 10 years. And especially the role of the non-bank financial intermediate sector. So that has grown significantly. So yeah, I really think, and I hope that it should stimulate the fact that the European economy has been more and more diverse funding sources. So one of the main priorities, in my opinion, is to develop the capital market union more and more. And I realize absolutely that we also have some additional challenges. But let's focus on the targets and the goals we have.
So just to round off, so we don't run out of time on delegation, we have a poll: should the EU set stricter limits on delegation to managers outside the bloc? And it's admittedly quite a small sample size, but 71% say yes. Which might be surprising for the industry perspective. But Natasha, would you like to weigh in on what the future of delegation should be?
Thank you. Thank you for this question. It has been coming up many times in the discussions around Brexit. It's a constant concern of the industry. So maybe first a few points to recall that everybody recognizes the importance and the need of delegation, and the possibility for asset managers to be able to go out and seek expertise in specific areas through delegation arrangements. It's recognized in EU legislation. As a French supervisor, we recognize it and authorize it regularly. And a second point is probably to say that the European legislation is very detailed in that context, and provides very detailed requirements when delegation arrangements are put in place. So we already have a comprehensive and detailed framework that explains how delegation arrangements can be put in place. Now, there have been questions of whether that would continue after Brexit, whether that would be questioned, and how that can take place. I think what I just wanted to stress is that the ESMA has put out a letter to the European Commission where it has identified a number of areas for improvement. On our end, we support most of those proposals from ESMA, in particular when they suggest that it can be strengthened and extended. So number one, to, for example, elevate the clarifications that ESMA had published in 2017 in its opinions in the Brexit context. That should find its place in the legislation. That would make sense, and I think everybody is expecting that. A second point is to say this detailed framework we have is only applicable in the AIFMD simply because it was developed in a later stage, but we have the same concept in European legislation in UCITS to say you're not supposed to delegate your activities to the extent of becoming a letterbox entity, but the letterbox entity is not detailed in UCITS, so we should do that as well. Maybe the last point is to say, yes, we are calling for an investigation of certain areas. There are certain types of delegation arrangements where so much activities are delegated outside of the firm that you might question what is still inside the firm. And we're just calling for the European Commission to look into that.
Which areas are those specifically?
It's just specific business models that have developed where we question the substance and the balance. You're not supposed to extend to delegate more than what you actually oversee yourself. But there have been models being developed where quite a significant amount of activities are actually outside the group. So we're just asking the European Commission, please look into that and see whether we might need to strengthen the system there.
Eric, do you want to give the industry response?
I'll be very quick. So look, UCITS is an incredibly successful product. I mean, I think one of the great innovations of the EU is the UCITS framework. And the UCITS framework obviously brings a lot of value to European investors, right? You know, we were just talking about we're in a low yield environment, right? People are trying to save for retirement. They're trying to save for, houses, that they want to live life, and having accessibility UCITS has been a real boon for European citizens. So when we talk about delegation, and delegation is part of kind of how UCITS operate today, I think the question is, okay, if you're going to make modifications to the delegation framework, what's the problem you're trying to solve, right? If you end up raising costs, if you end up removing choice, if you end up weakening the expertise of these funds, it's the users of UCITS who are going to suffer. And again, I think public authorities need to consider both sides of the equation. So that's really our bottom line, is just please consider the full picture.
Caroline or Francesco, do you want a last word on that? Any opinion on the extent of delegation? Francesco's saying no.
Honestly, is out of our domain.
Okay, Caroline, you get the last word then.
Yes, but I can be very short, because I think this panel shows as well, but also what you saw in the last 10 years, not taking into account Corona, but what you saw that the total assets under management steadily rose in the last 10 years, over the last 10 years. So it shows again that the industry, how important it is and what type of player it is in this financial market. So, and also this panel shows it again. So hopefully I can have some bilateral chats with the industry to talk further about this very important topic. Thank you so much.
There's certainly going to be more to talk about based on all the possible reforms that were raised during this panel. So thank you very much for taking part, and I'd like to really thank you for your expertise. So the next session is a spotlight discussion with a focus on the review of Solvency II. It will start at 3:50 p.m, so do stay connected, and in the meantime, explore the app and book meetings with your peers. Thank you very much.